The Securities and Exchange Board of India has allowed debt mutual funds to have a side pocket. A side pocket will allow fund managers to separate toxic assets from the rest of the good assets of a debt mutual fund. The toxic assets could be bonds or debentures or certificates of deposit or commercial paper which are hard to sell because of a default by the issuer or some such adverse development. Side pocketing will allow the fund house to create two portfolios. One will hold the healthy assets and have an NAV based on the market value. The other portfolio will house the toxic or bad assets. The portfolio containing toxic assets, the side pocket, will be frozen till a value is arrived at for those assets. No investments or redemptions will be allowed in this portfolio. Investors can subscribe to or redeem investments in the portfolio with healthy assets. Side pocketing ensures that some investors do not benefit at the expense of others. Assume an issuer defaults and some investors choose to redeem their investments. In the absence of side pocketing, investors who stay behind will be at a disadvantage. This is because the fund manager will have to sell the good assets to repay the investors who redeem first. By the time other investors come forward to redeem their investments, there may be no good assets left. With side pocketing, all investors will be equally affected if some assets in the fund become unsaleable. SEBI has made side pocketing a norm for mutual funds in the wake of serious defaults at infrastructure leasing and financial services, and its impact on liquid funds that held IL&FS securities worth 2,800 crore rupees. Ring fencing risky assets will help fund houses manage redemption pressures better.